Overall, the global economy continues to weaken, including the USA, much like we have been discussing for quite some time. We've been talking about a gradual weakness in the USA as well as the global economy for numerous months, but nothing that was that worrisome. In other words, it's pretty much been on the same downward trend. It's been a pretty mild decline in the economic momentum, so it's not been worrisome. The only caveat related to that is that, once again, it's not what we understand to be the reality that is the ultimate say, right? We also have to consider, primarily, we have to consider what investors are thinking, right? It's about sentiment. It's about expectations. We don't move the markets. Where it's helpful is for us, if we're able to accurately forecast things such as earnings, economics, the market, other things. If we're able to forecast these things in advance, we also have to keep in mind what investors are thinking, because if they're not on the same page we are at the same time, then that can mean things can change when they do, in fact, get on top of our bandwagon, right? So this is an important factor always to consider. It's not always what is going on from an accurate standpoint right now, or what will happen down the road based upon our assessment of risk analysis. We also must factor in what we feel investors are thinking. And by doing that balancing act, we can oftentimes understand the movement of markets in individual securities. Okay, I think you all are getting a sense of that. I've been discussing that off and on for quite some time in terms of my focus of discussing why and how the IMF has been behind the curve, right? We've talked about how that pertains to what's going on in the market. So it's important to keep this aspect of forecasting in mind. It's not just what we think, it's also what the market thinks. And in many regards, one could argue it's more important to know what the market thinks, at least over the short term. But over the longer term, the bigger picture, we need to really understand both sides, and assuming that our analysis is accurate. And it has been pretty accurate for quite some time, I believe, and I hope that you agree. So with that little prelude, I suppose you could call it, my point behind that is that we have been talking about the gradual weakening of the U.S. economy, of the global economy. And once again, we've been pointing to the IMF having been behind the curve for quite some time. The Federal Reserve has been behind the curve, as evidenced by its flip-flopping on interest rate forecasts and so forth. Meanwhile, we had discussed long ago when we thought interest rates were going to be raised for the first time in several years, as December 2015. That's what happened. And we've been talking now, well, a few months ago we talked about June. We wrote that off at least in the May, if not the April issue, based upon the economic data, not only in the U.S. weakening, but also in the global economy. And we pretty much said the June rate hike last month, if not before that, was off the table. Of course, more recently with the June 3rd, really disappointing, if not worrisome, jobs report, once again, we reiterated that, and you can see in the opening statement of the June Intelligent Investor that we basically said that was off the table as well. In fact, we think that July is not going to happen. September is a possibility, but we still think that we're looking at December 2016. And once again, to reiterate, there's really no need from an economic standpoint, there's no justification to raise rates. But we feel it's a symbolic move by the Fed that needs to be done, or at least they think so. In addition to that, we also feel that the Fed wants to have some cushion, some leverage to lower rates if they need to down the road. Because when we do hit a recession at some point, if the rates aren't high enough, obviously it calls into question whether or not the Fed creates a negative interest rate environment. And we certainly don't want that. The Fed doesn't want that. In fact, there's question as to whether it's even legal in the U.S. law. So nonetheless, that doesn't really matter, of course, right? No one seems to follow the law. But I can tell you that if the U.S. has to hit negative interest rates, that's a pretty dire situation for the rest of the world. Does that make sense? Well, At first glance, no. But when you look at it in perspective of equity risk premium, that is the chances of lower rates, the chances have increased that the Fed is going to push forward when they raise rates. That bodes well for the stock market. And I mentioned this last time as well in terms of the Fed rally, right? So we're seeing some atypical things. We're seeing a larger extent of the Fed pushing the market up over the past few months, beginning from really the middle of March, March 16th, when Yellen, of course, came out and basically said at most we're probably looking at 50 basis point increase in interest rates for 2016. Prior to that, all the economists, everyone in the Fed, they were all saying, 100 to 150 basis points in 2016. So that obviously gave a boost to the market. Prior to that, we had the big boost in the oil rally. And of course, the oil has continued to rally since Yellen's speech in mid-March. And that's also helped the market. But for the most part, you can look at the rally we've seen since mid-January in the stock market due to a kind of a two-phase for the most part. In the first half, it's been the oil rally. In the second half, it's been the Fed. Of course, the oil rally, once again, has also carried over or spilled over into the second portion to augment the Fed rally. And of course, we've also seen a smaller influence, I believe, in the earnings improvement. That is to say, earnings have beat their downward revision. In other words, the expected earnings decline has been reduced from the beginning through the earnings period. Nonetheless, we're still looking at a trend of gradually weakening earnings, and there's many other factors we've been talking about. So overall, given all the risks, recently the World Bank lowered its 2016 global growth estimates down to 2.4% from a previous 2.9%. And as you recall, I've been talking about my view that the World Bank has been a little bit better than the IMF in their growth forecasts. They have been a little more ahead of the curve than the IMF, but they've still been behind the curve. This 2.4%, I think, is pretty realistic. I think it's a pretty good estimate, assuming there's no blowout in China or any other spillover. Probably going to get 2.3 to 2.5. It really depends upon the USA, because the USA actually had a huge downward revision, and this resulted in a large drawdown in the global revision, as you can imagine, because of the importance, the overall size of the U.S. economy. This, of course, impacts sentiment. However, you'll notice that the market really hasn't reacted that much to the World Bank's recent downward revision. But I think, once again, overall, it's pretty realistic. I'm not saying it's perfect, but it's much more realistic than the IMF at this stage. And I would have to believe that the IMF over the next 30 days is going to come up with some type of a downward revision as well. As we've been talking about for quite some time, deflation continues to persist in the EU and Japan, kind of up and down, right? There's periods of mild deflation followed by some mild recoveries and so forth. But we're seeing now this situation increase, and this is the second consecutive month in the EU that we're seeing a mild deflation. I've also been talking about how I think that QE is going to continue. They're going to ramp it up more in the EU, whereas in Japan, probably they're going to focus on other types of monetary stimulus packages, such as, I don't know, at the very least, reducing interest rates, because the quantitative easing, they've done a lot there, and I don't think that they can really count on that, but certainly something is going to be done. The yen continues to rally. It's not helping the Japanese economy by any stretch of imagination. So Japan is definitely going to intervene. To close out this discussion on interest rates, getting back to the U.S. and deflation, I wouldn't worry about it. If you sit here and worry about, well, what if the U.S. has negative interest rates? What am I going to do? I don't really see any major way to change your investment strategy, right? I've talked about before how deflation destroys the stock market, inflation destroys the bond market, right? Well, if rates are negative, or if the Fed is reducing rates, that means they're trying to reduce the chance of deflation, right? So you should actually welcome that. And, aside from the fact that you're not getting really any yield in the bank, I don't think that the negative rate situation will affect retail deposits. I'm pretty confident that's not going to happen. Let me begin by going over one of the things I mentioned in the June forecast, and that was a brief discussion on sentiment. Now, I haven't talked about sentiment specifically so much in these forecasts. This is something probably I will address in season 2 of the Investor Bootcamp. So, with that, let me go ahead and review now this section on the sentiment that I discussed in June. Now, I began talking about the importance of understanding reality versus what the herd thinks is going on. Keep in mind that market-based asset pricing, and that is publicly traded securities, market-based asset pricing. So anything that's traded publicly. These types of assets are determined by what most investors believe, their perception, right? And that would be regarding the economy, valuations, earnings, risks, and so forth. Their perceptions on those variables, on those things, right? So market-based asset pricing is determined based upon what most investors believe. So when these investors are wrong, market-based asset prices, that would be publicly traded stocks and bonds and everything else, right? When they're wrong, those types of assets won't be accurate with respect to the norms of valuation metrics. So in other words, when they're wrong about their perceptions, obviously you're talking about a correction in the pricing of those. And recently, of course, we saw a great example of that, and that was with this bet that the street made on the UK referendum voting results. They thought that the UK voters would vote to remain in the EU. And so they basically went into the market, bought up all kinds of assets, pushed the markets up, and they were wrong. And what happened? Well, immediately, asset pricing was inaccurate based upon all the things they had factored in terms of forward risks and so forth. And so what happened? This is why the market dropped immediately in pre-market trading to readjust to the assumptions that they were wrong about. So irrespective of whether the market or the street is right or wrong, the bottom line is this. Eventually, all market-based asset prices, or all market-based assets, the pricing in those assets, in other words, publicly traded stocks and bonds and related securities, derivatives, so forth, eventually the pricing in those publicly traded assets are going to correct. Therefore, that means, of course, the markets are going to correct to reflect a more realistic picture as investors begin to see what's really going on. So in other words, you can have periods of extreme inaccuracy or overvaluation or even undervaluation in markets, in individual asset classes, in individual securities. But eventually, markets will get it right. So we've got the situation whereby you've got these investors who may have gotten things wrong. And we're talking about the street, basically, the massive investors. Most investors got it wrong, right? Eventually, these things are going to correct. However, sometimes things change in a way such that investors who got it wrong initially can look like they got it right because the changes that took place at a later time. So ultimately what ends up happening is these investors who completely missed it from the beginning, they look like they got it right because of changes that occurred which were kind of lucky. So they got lucky. And this really alludes to the situation where you've got these guys who are broken clocks, right? Eventually, if you keep saying something and you don't change it, eventually you're going to be right. But are you right? No, you're not. So I just wanted to point that out because that's a pretty common situation with investors. And a lot of less experienced investors fall into that trap. They've gotten lucky, and that kind of boosts their confidence, and it's boosted for the wrong reason. Give you a good example. If you have happened to have bought some security when it was in a distressed state and you got lucky and you thought that you know what's going on, and therefore buying distressed securities becomes part of your investment strategy as a result of your prior luck, well, you're going to find out eventually, probably sooner rather than later, that it was luck. So let's begin now with the comparative analysis of the three